and you're enjoying your summer. Everybody's staying healthy. This is a very popular webinar. Alex and I actually gave it in January, and we're repeating it, of course, again today. Had over 100 registrants, and we had lots and lots of questions. So we will hope to get certainly cover most of the information in the slides, and then we are planning on taking questions at the end as well. And before I start, I just wanted to say congratulations to Alex. He is our new partner, admitted into our partnership on July 1st of this year. So kudos to Alex. Yes.
Thank you very much. Appreciate it.
Okay. So just a little history on the Social Security Act. It actually was signed into law 100 years ago, by President Roosevelt in 1935, which is 100 years before it is determined that the surplus will be depleted for the Social Security fund. So we're going to be going over exactly what the health status is of that fund. Medicare was passed in 1965. Survivor and spousal benefits were added in 1939. And then in 1984, federal retirees that decided to leave the civil service system, they were also allowed to be covered by the Social Security system. Next slide, please. So what is the status of the Social Security Trust Fund? It's referred to as OASI, or the Old Age Survivors Insurance Trust Fund. And the last report that I could find online was dated April of 2020. So unfortunately, some of the information is a little out of date. It'll be interesting to determine what the impact of COVID will be on it. But for right now, the trust fund, according to the trustees, has about 2.9 trillion in reserves at the end of 2019. And of course, benefits are going out and increasingly outstripping income. In June of 2020, there were 180 million workers paying into the Social Security system, with 65 million retirees receiving benefits. So essentially almost a 3-time ratio, which is pretty low considering how the trust fund has been funded in the past. As I mentioned, the trust fund is anticipated, the surplus in the fund is anticipated to be depleted in 2035, which is only 14 years away. And the system will exhaust its cash reserves, and the continuing tax income will be sufficient to pay only 79%, it's estimated, 79% of scheduled benefits for at least the next 75 years. Of course, why is this happening? Well, it is that reduction of the number of people paying into the system versus the number of retirees due to the baby boomers, and birth rates have dropped. There's no question that Congress is going to need to act to help shore up the system. They have many tools in their tool chest. They could raise the retirement age. Most likely it would be for those younger, obviously probably 50 and younger now. They can raise the threshold that the maximum threshold for contributing into Social Security. They could raise the rate that employers and employees pay into it. There's various different mechanisms that they can try to do to get more funds into that system. So I don't think Social Security will die, but it will. Changes will need to be made. It's historically, unpopular for either party to bring it up, but it will need to be made certainly within the next 14 years. Next slide, please. Okay. Just basic understanding of Social Security. How do you qualify? You need 40 Social Security credits in order to qualify, and you earn basically 4 a year if you had at least $14.70 in earnings per quarter. In other words, it takes 10 years to qualify. So if you have any yourself or loved ones that may have worked in the federal government in the old system, or whatever their situation might be, if they have some credits but they don't have the full 10 years, urge them to go ahead and get the full 40 Social Security credit. It doesn't take a lot of earnings to actually do that. And of course, you must be age 62 or over or disabled in order to qualify. What about spouses? So spousal benefits can begin at age 62. as long as the spouse is claiming Social Security benefits. The spousal benefit can be as much as 50% of the working spouse's full retirement age benefit. And quite a mystery, often people say, well, how is my benefit calculated? It's based on what's called average index monthly earnings, and it's an average of up to 35 years of the worker's indexed earnings. The system does choose those years with the highest indexed earnings. For example, if you receive $2,000 a month in Social Security benefits, a worker would need to have inflation-adjusted annual earnings of roughly $60,000 for a course of 35 years to receive that $2,000 benefit. I urge you to view your Social Security statement online. You can create a My Social Security account at myaccount.socialsecurity.gov. Check the completeness. There are situations where not all of the Social Security earnings have been reported correctly. So, do that now. Don't wait until, 62. And the same site is where you apply for benefits. There are online calculators on there, and you can find out what other benefits you might qualify for. So it's really quite robust. What is your full retirement age? You can begin to collect at age 62, but full retirement age depends on your birth. It is currently 66 and 2 months and gradually is increasing to age 70 for people born in 1960 or later. And you can further increase your benefit by delaying to age 70, which we will be going over. In the case of early retirement at age 62, this is very important. The benefit is reduced 6% annually for each year you draw early. A credit is given of 8% per year for delayed retirement after full retirement age. So, and up until basically age 70. So it is a forever penalty or forever bonus. It's very, very important that you consider this when you're making your decision to retire. Okay, next slide, please. Okay, will Social Security benefits change once received? Right now, the Social Security benefits are increased annually based on the Department of Labor's Consumer Price Index. For 2021, the increase was 1.3%. There's question marks for 2022. As you've been following, inflation has been pretty high this year so far to date, and whether or not that means that Social Security recipients will get a very nice increase in their check next January. I'm thinking they will, but that's something to consider. Now, how Social Security is taxed. This is we had a lot of questions on this. If your total income, if you file single and your income is $25,000 or $32,000 married filing joint, your Social Security benefits will be subject to tax. At that point, they're taxed at 50%, and then there's an upper bracket where they can be taxed at a level of 85% of your benefit. Now, states differ, but we're talking federal income tax up to 85% of your Social Security benefits could be taxed. From a tax planning standpoint, you really want to consider how to keep your tax total income lower, right? So that you can avoid having your Social Security tax. Some ways to do that are tax efficient investing, right? So you want to limit the amount of investment income that's actually reported on your tax return, which is increasing your total income. And also consider qualified charitable distributions from your IRAs, right? That would reduce the amount of above the line in your total income, reduce the amount of IRAs that's reported as taxable income. So these are just a few tricks that we do when we help clients plan how to minimize the tax when they start receiving Social Security benefits. While we're not talking about Medicare in this webinar, I will just say that you want to make sure that you enroll within 3 months before or after your 65th birthday, and that the enrollment in Medicare and Social Security do not need to be made at the same time. We do get that question sometimes. Alex and I, along with an attorney, made a presentation in February, which you can find on YouTube, or we would be happy to send to you on Medicare and Medicaid planning. It was a very, very well-received webinar, so urge you to go ahead and take a look at that. One last item, I just wanted to caution you, if you work and receive Social Security benefits before your full retirement age, so let's just say you're working up to age 66, the benefits are reduced. Your Social Security benefits reduced $1 in benefits for every $2 in earnings above the annual limit. Now in 2021, the annual limit is $18,960. So that means that retirees could go and get a part-time job, earn up to $18,960, and they'd be okay. But if they earn more than that, their benefit is going to be reduced. Seems a little unfair, but that's the way it is. After full retirement age, there is no penalty, and you can continue to work and receive your Social Security. Okay, next. These are items to consider before applying for benefits. It's not all exhaustive, but it's a start. First thing is obviously financial need. You need to make a budget for your retirement. Many financial planners will say you need approximately 70% of pre-retirement income when you retire, but it really is a case-by-case basis. And of course, consider your other sources of income, pensions, annuities, investment income, right? So put together your budget as to what you expect you'll actually be needing once you enter retirement. Life expectancy. Right now, it's 84 for men and age 87 for women. Of course, we've probably all read the headlines recently how the average life expectancy has actually gone down for two reasons. One, unfortunately, is all of the deaths from the pandemic, and the other is from the opioid crisis. So many people died. It's actually lowered the life expectancy in America. So something to consider. Health condition. So if you have any chronic, what's considered basically chronic conditions, diabetes, smoking, obesity, obviously life expectancy is expected to decrease in that situation. Genetic history. Consider your parents' health when they died. Predisposition to certain illnesses. Obviously consider the advantages of delaying your claiming. And Alex has got some great examples he'll be going over with you. Whether or not there are options for spousal benefit claiming, and long-term care needs. So if you anticipate you might have long-term care needs and you may or may not have insurance, these are items to consider before deciding to apply for benefits. Alex?
Thank you, Judy. And again, thanks everyone for joining us today. So before we talk about different strategies, and we certainly have quite a few of them to cover, I just thought I would share a couple of tables with you essentially, and just to kind of touch on what Judy mentioned a bit earlier. So in terms of the life expectancy, there's actually a full table that you can find on the Social Security website. So if you're 55-year-old male, well, according to Social Security, your average life expectancy is 83. If you're a 75-year-old female, your average life expectancy is 89. And you can perhaps already notice that essentially the older you are, the longer you're expected to live, at least statistically speaking. So that is not a mistake. That is actually how it works. There are other life expectancy tables out there. There's actually multiple. And I'll mention that when we do the planning work for our clients, when we talk about their retirement planning or Social Security planning, we would usually do it to age 95. So that is our benchmark scenario. And as Judy mentioned earlier, if we know more about them, perhaps there's some kind of chronic condition in place, then we'd adjust it. But these are the actuarial numbers. In terms of your FRA or full retirement age, I do suggest that you essentially remember what that age is, for yourself and perhaps for your spouse. It's really easy. If you were born in 1960 or later, it's it's 67. For those who were born from 1943 to 1959, it's essentially between 66 and 67. And very few people at this point are not collecting yet. The FRA would be less than 66. So essentially for most people, it's between 66 and 67. So in terms of maximizing your benefits, well, of course, step one is to understand when you can actually apply. So again, the earliest age that you can apply under normal circumstances is age 62. And as Judy mentioned earlier, your benefits would be reduced by up to 30% compared to your full retirement age, and we'll just assume it's 67 in this example. If you decide to, once you reach your full retirement age and you decide to wait, perhaps all the way to age 70, your benefits would increase by 8% each year, or portion of the year, regardless if you work or not. And that is a very common question we get. So once you hit that point and you just decide to wait, your benefits will continue to increase regardless if you work or not. Now, when we do the planning work with our clients, we actually tend to focus on these three thresholds, 62, 67, and 70. In practice, you can actually collect your benefits at any time between essentially 62 and 70. So if you're planning to do it at 67, but then, life happens and you want to do it at 65 in 3 months, that's perfectly fine. There are other things you should consider. If you ever wanted to do it at age 70, but then again, things change and you want to collect at 69 in 3 months, that is fine too. And that actually happens relatively frequently. Judy already talked about the earnings test, so I'm not necessarily going to repeat what she mentioned earlier, but I will say that for most people who have not reached their full retirement age yet and who are earning, let's say, more than $50,000 a year, I'll just use that as a threshold, it is very unlikely that they should be collecting their Social Security benefits. Essentially, they would not be receiving any. Now, it is not a permanent loss. Anytime people ask me that question, I would clarify that your benefits will continue to increase. So then when they're resumed, let's say at your full retirement age, you'll get a larger amount, but it simply makes very little sense to apply if, let's say, you're expecting to earn more than $50,000 before you reach your full retirement age. Now, this is perhaps one of the most common questions we get on the break-even analysis. And before we go in detail here, I will say that this is a generic analysis that was published by the Social Security Administration. You can actually find it on their website. In practice, it will likely look different for most of our clients, and especially if we adjust it for taxes. So what you're looking at here assumes that this person would receive the maximum possible benefit, but it's not adjusted for taxes, and that's very important. So let's start on the closer to the bottom of the slide. So let's say you're trying to compare if you should collect your benefits at the age of 64 versus 70. What's the break-even point? Well, it happens to be 79 years and 1 month. So if you expect to live beyond, essentially age 79, maybe to 85 or 90, then in this particular case, perhaps you should consider waiting to age 70. Now, I will tell you that is not a very common comparison. Usually people would not compare those two. The one in the middle here is more common. When you say, should I collect, let's say, at 64 versus 67? And in this particular case, the break-even happens to be 78 years and 11 months. And the one on the very top here, between 67 and 70, is actually the most common question we get. Should you essentially collect it at your full retirement age, which is 67 for many people, or should you defer all the way to age 70 and receive the maximum possible benefit? Well, the break-even point is 79 years in this case. Now, one thing I want to mention here, and perhaps you noticed that, perhaps not, but by not collecting your Social Security for a certain number of years, make it 3, make it 4, make it 5, well, you're leaving a certain sum on the table. Now, the fact that you live to age 79, maybe even 80, well, you're better off by just a year, essentially. So in some sense, again, you're gambling. So yes, we can calculate that break-even point, but at the very least, I would usually mention that you are, leaving some funds on the table potentially, especially in the earlier years of your retirement. Now, in terms of different considerations, different strategies, when you should be collecting, age 62, again, the earliest under the normal circumstances, the maximum benefit in 2021 happens to be $2,324,000. Why would you ever decide to take this route? Well, perhaps you're in retirement already. You no longer plan to work. You have some immediate cash needs. Perhaps you want to cover your expenses, or perhaps you want to travel more. And again, in the earlier years of your retirement, perhaps you have limited other resources. There's no pension in place, no other income. Perhaps your portfolio size is relatively small and you do not necessarily want to begin depleting it. You want to postpone that for as much as possible. And I would say the most important one is if you expect your life expectancy to be shorter than on average. In practice, we relatively rarely plan for our clients to collect their benefits this early. It just doesn't seem to work that well. But then, of course, things happen. You plan to collect at 67, but then life happens, and that's one of the decision points in terms of what should you change in your plan. Well, perhaps you should be collecting your benefits sooner. The full retirement age, or FRA, the maximum benefit in 2021 is $3,113. And I'll tell you, for most of our single clients, and not so much for couples actually, that happens to be the most optimal age to collect your Social Security benefits. Two main reasons behind that. Well, there's no more penalty for any earned income. So if you want to continue working, earning decent income or little income or any other amount, there would not be any penalty. And in this particular case, again, if we're planning for the long run, we're simply assume that your life expectancy is average. That's the assumption we'd usually make. Now, why would you want to wait all the way to age 70? Well, of course, that's when you would get the maximum possible benefit. Happens to be $3,895 in 2021, right? What are some of the other considerations? Well, perhaps you're a conservative investor, right? And that happens relatively frequently, of course, as people, get closer to their retirement years. And let's say you expect your portfolio to earn 4%. I'll just use that as an example, 4%. Now, you compare what you would be earning from your portfolio, again, 4%, versus how much your Social Security would increase in value, which is 8%, in some sense risk-free, because all you have to do is essentially wait. And perhaps it's a better decision for you to simply use your own funds. And of course, in this case, you would have to consider, again, your tax situation. Perhaps you have other sources of income. Many of our clients are either current or former government employees. We work with many of them. They have good pensions frequently, and perhaps they cover, a good half, maybe even more of their income, and there's just no need, for any additional income at the time. So they would rather receive more later. And again, and as I mentioned this earlier, usually for this scenario, the assumption is that you would live longer, that you have an above average life expectancy. Every argument, every point I just made isn't all that strong if someone tells us, well, you know what, I'm not necessarily in the best shape ever, and I would rather receive more now. So again, some of the things for you to consider. Now, as a side note, and we will actually have a webinar dedicated to long-term care in October of this year for those of you who are interested. But this is usually discussed as part of someone's financial plan, and we'll touch on that when we talk about Social Security. So according to a study by MetLife, the best age to apply for long-term care policy happens to be between 48 and 54 from the cost-benefit perspective. For those of our clients who are, let's say, in their early 60s to mid-60s, it may become prohibitively expensive for a variety of reasons, actually. And what I mean by saying prohibitively expensive, we're talking $700-800 a month for a decent policy, even more than that for better policy. So a potential strategy is to delay your Social Security benefits, right? Let's say you're waiting from 67 to 70. that would give you an additional benefit, assuming you're at the max, of roughly $800 a month for life, inflation adjusted. So you have that hedge in place. Now, at least hypothetically speaking, if you're not making any long-term care premiums, well, presumably you have more income, you have more cash flow that presumably you would consider saving. Let's say it's $500 per month or $6,000 a year. If it grows at 5%, which is a modest rate of return, you're looking at $77,000 in 10 years. 20 years, let's say you do it from 65 to 85, we're talking $206,000. So you have that additional pot of money, so to speak, available for long-term care or something else. Now, will this solve the problem? If long-term care is something that you're worried about, well, probably not. You probably really want to look into that more. But this is, again, one of the considerations when you're trying to decide, should I collect now my Social Security benefits or later? So when we work with couples, claiming strategies for married couples, and I'll tell you, this is one of my favorite discussion points when it comes to Social Security. So we will go over two examples. One of them is relatively straightforward. The other one is not so much. Before we do that, I will say this is for illustration purposes only. We assume that our husband and our wife will receive the maximum possible benefit. And of course, if that's not the case, the numbers would look differently. We're not adjusting for inflation. And by the way, if we do, the outcome is not going to be drastically different. But what's most important, we're not including taxes, because the outcome can be drastically different if, again, you adjust for taxes. So I want to make that clear. Now, if I'm about to say, multiple things, if you just don't remember, or perhaps doesn't make complete sense to you, try to remember this. If there is a significant age difference between you and your spouse, 5, 7, maybe 10 years, very frequently it is not the most optimal choice for you to begin collecting your benefits at the same age. So let's say 67 or 70. And again, as we talk about this, I'll try to demonstrate it. So in our example 1, right, our husband is 67 years old and he is expected to live to age 85. Our wife is 60 years old and her life expectancy is longer, to age 89. And as a result of that, she is expected to outlive her husband by 10 years. In our scenario A, I like to refer to it as our benchmark projection, we'll assume that both of them simply collect their benefits at the same age, which is 67, meaning the husband collects immediately, he collects now, and then the wife waits for 7 years. The present value of this option, we discount back, is $1,389,000. So that is our starting point. Can we do better than that? So in scenario B, our wife is going to collect 2 years from now at the age of 62. Again, that's the earliest age she can collect her benefits. And our husband will begin to collect immediately, again, at the age of 67. Well, in this scenario, the present value is higher, say significantly higher. It's $1,443,000, or $54,000 better than, again, scenario A. There are two reasons behind it. The first one is, well, wife is now collecting for 5 more years, right? She's not waiting to 67. She's collecting at 62. More importantly, since we're expecting that she is going to outlive her husband, she is going to inherit his benefit, which is going to be much larger than her own. And that is a very important point. If you're married and your benefits are the same, essentially there's no hedging in place, meaning if one predeceases the other, you would not inherit the other person's benefit because it's the same. You can never have both. It's either your own or your spouse's if it's larger. And that's a very important point. Now, can we do even better than that? Well, in scenario C, our wife is going to collect at 62 and our husband will wait for 3 years. So then he would really maximize his benefits. And in this case, the present value, again, of this choice is $1,563,000. So essentially, we maximized this family's lifetime benefits. So our second example may appear to be simple, but it's actually not all that simple. Our husband and wife are the same age now. Both are 67 years old. The wife is still expected to outlive her husband by 10 years. Again, our benchmark scenario, we're saying that both of them collect at 67. What's the present value of that choice? Happens to be $1,588,000. Again, can we do better than that? In scenario B, the husband waits for 3 years and then begins to collect at the age of 70. Perhaps you're not surprised by the outcome. It happens to be better for them. It's $1,850,000, actually significantly better than scenario A. In scenario C, both of them wait to age 70, right? And as a result of that, both of them will receive the maximum possible benefit. And in this case, the present value is $1,945,000. So if you just compare the 3 options, well, why wouldn't you go with the third scenario? With scenario C, it gives you the maximum possible benefit. Now, if you dig a little deeper, you would compare scenarios B and C. The difference in today's dollars, that's why we're doing the present value calculation, happens to be $95,000, significant sum. However, the amount of uncollected benefits by wife, because she's waiting from 67 to 70, happens to be $99,000. So in order for her to gain this additional sum of $95,000 in the long run, she's leaving $99,000 on the table because she's not collecting for 3 years. So chances are, if we're working this couple, and of course disregarding all other variables, would actually recommend scenario B because it's safer, because you don't have to essentially gamble on someone's life expectancy. The bottom line, again, if you're married and you're considering your Social Security options, take a look at it, analyze it, and of course your personal circumstances must be considered. And with that, back to Judy.
So many of you have probably heard of what's called the file and suspend rule. Sadly, it was eliminated in the Bipartisan Budget Act of 2015, but we're including it here because it still applies to those born before January 2nd of 1954. So essentially it means you would be age 66 in 2021. In order to take advantage of the file and suspend, you have to be married. The lower earning spouse has to initiate the process first, has to apply for benefits. And then the higher earning spouse applies for a restricted application on spousal benefits. When the higher earning spouse reaches age 70, they switch to their own benefit, which is grown by 8% per year. This strategy essentially lets the beneficiary restrict an application for spousal benefits only, giving the beneficiary Social Security now while allowing his or her own benefit to grow 8% to age 70. As I say, it really is only going to be applicable to those born prior to January 2nd of 1954. Did want to mention it because there are those out there that still have not decided to start claiming, and they should be aware of this. Okay, what are the rules if you're divorced? So ex-spouses do catch a break. The couple would have had to been divorced for 2 or more years. And when they are, they're considered to be independently entitled to Social Security benefits. As long as the couple was married at least 10 years, an ex-spouse who is still single can file a restricted application for spousal benefits, only regardless of whether his or her ex has claimed the benefit. We did get a question prior to this webinar is how do you determine if your ex-spouse is not cooperative? How do you determine what their benefit is? And we have had a situation with that exact situation. If you contact the Social Security Administration and provide the information for your ex-spouse, they will disclose that information to you. So you don't actually have to contact the ex-spouse to do this. You can do it through the Social Security Administration, assuming you have their Social Security number, date of birth, and information where you can prove your identity and your relationship. What if you're widowed? So You must have been married at least 9 months to the deceased to qualify for a benefit. You must be at least age 60 or 50 if disabled. In most cases, survivor benefit is based on the benefit amount of the late spouse. And the amount that you receive is going to be based on when you claim, specifically the age that you claim. If you qualify for retirement benefits on your own record, you can switch to your own as early as age 62. And remarriage does not impact the survivor benefit. So you have to always consider your situation and also consider the spouse's ex-spouse's situation as to when you want to do this and if you qualify. Okay, what if I make a mistake? We have run into this. Somebody has applied for Social Security, come in, and we've said, well, maybe you might want to rethink that. You can actually fix it if it's within a year of filing a claim for Social Security. You must be under the full retirement age to do this. And of course, you have to pay back all of the Social Security benefit received. That's hard for some people, but we have had, had that happen, because when you can demonstrate that they're clearly going to be better off waiting, then they just write a check back to the Social Security Administration of the Social Security benefits that they did receive. There's one withdrawal per lifetime, and you may need to amend your tax returns if you ended up having to if it crossed the tax date and you had filed a tax return claiming Social Security benefits that you then paid back. What if you suspend your benefits while you continue to work? So if you've reached full retirement age but less than age 70, all benefits are going to be based on the earnings record, would also be suspended, meaning a spousal benefit would be suspended, but divorce benefits do not, as they're considered independent. You would need to make your Medicare Part B premiums out of pocket, because normally those are deducted from your Social Security, but if you wait, you can go ahead and pay those out of pocket. And you can begin to receive delayed retirement credits to increase then your Social Security benefit. And you would be ineligible for supplemental security income if you decide to suspend your benefits. With that, I think we then are up to our questions, right, Alex?
That's right, and we actually have quite a few, so we thought that we would put 4 of them here on the slide, and then we have a long list of other questions. So I guess I will start with the first one. Can I still receive Social Security benefits if I live abroad? So what do you think about this one, Judy?
Yes, so many, we call them expats, but there's many Americans that live overseas. A lot of them live in Mexico or Europe. My father, I know, he lived in New Zealand. And, there's kind of communities of Americans living abroad, and absolutely, they still receive their Social Security benefits. As a U.S. citizen, they're still would be required to file a tax return in the United States and declare their income, but they are not prohibited from receiving the benefits just because they decide to move abroad.
Thank you, Judy. Here's the second one. What happens to my Social Security benefits when I die? So I guess I will cover this one since I touched on that throughout the presentation. Well, if you die with an eligible spouse or dependent children up to the age of majority, your Social Security benefits would be paid to them. But again, with the spouses, what's important, you can never receive 2 benefits at the same time. It's either your own benefit or your spouse's benefit, whichever is higher. And that's, again, why it's so important to plan for, I like to refer to it as hedging, right? Because we don't know what's going to happen in the future. And that's why, again, it's important to consider not collecting the benefits at the same time, again, if you're married. Here's another one, again, very common. If you plan to work until age 70, is that the point where you must take Social Security? Judy?
I'll let you take that one, Alex,
Well,
because I'm going to do the next one.
That's a very easy one. Again, it's a very common question, but there's no benefit whatsoever for waiting to collect your benefits beyond age 70. Your benefits will not increase after that point. To be technical here, well, yes, they'll continue to increase by the cost of living adjustment. I believe it's what, 1.6%, but that's it. So once you reach that point, once you begin collecting your benefits, they will no longer increase unless, again, it's an inflation adjustment. How
So one of the questions we had was, how is Social Security tax for state income tax purposes? There are 7 states actually that have no state income tax at all. We have a 3-part retirement planning webinar series that we put on, one for kind of new workers in the workplace, one for mid-career, and one for kind of post-career entering retirement. And we cover this where, when you decide to retire, it's very important actually to decide where you want to retire and what state you're going to be a resident in. The 7 states that have no income tax at all are Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. So many retirees do end up in those states so that they're sheltering all of their otherwise taxable income from state tax. There are 37 states plus the District of Columbia that do not tax Social Security benefits. And I'm happy to say that Maryland and DC are among them. Maryland, DC, and Virginia are among them. So states have been very nice to retirees because they don't want them all moving out of state. They want to keep them in their states. But it is something that you definitely want to consider in terms of where you plan on residing when you retire.
Thank you, Judy. So we have many other questions, and we'll try to cover them over the next 10 minutes or so. But to take some from the chat box, one of the questions here, and by the way, feel free to ask your questions. We will read them out loud, but we will not mention your name for privacy purposes. So again, feel free to ask. Is the widow benefit a monthly amount or lump sum or either? So I guess the answer to that question is simple. It's a monthly amount. In terms of the lump sum benefits, Social Security pays 200 some. It's a ridiculously small amount.
250, I think.
250 right? Is what it is.
It's supposed to help pay your, burial costs.
Not sure. Pay for flowers, I guess. But it's a monthly benefit. Is the answer to your question. The other one here, I believe that question was asked when I was actually talking about my slides. I thought the spouse was limited to 50%. So the answer to that question, when you're collecting your benefits before, when both you and your husband are still alive, or your spouse, you can either collect on your own or 50% of your husband's if it's higher than your own, or your spouse's, I should say. What I was referring to when I was talking about hedging and different strategies is when you live, let's say, to your 70s or 80s, and the idea that you would inherit the larger of the two. Well, presumably in this case, it would be the husband's benefit in my example.
Okay, so we have a list of questions. I'm just going to start, Alex, from the top.
Yes.
Does the amount of your monthly benefit continue to increase if you stop working but put off collecting until a later date? So yes, I think we described that. We went over those examples. It'll continue to increase up between, up to your age 70 benefit. And then thereafter, as Alex pointed, you should take your benefit at age 70. But if you stop work, yes, that's the power of allowing it to increase, and the return between full retirement age and age 70 is higher than you could generally get in a stock market. Certainly for fixed income, it's higher.
That's right. So here's the second question here. Is there a threshold for adjustments to the monthly payment? That is a point below which there will be no further reductions in the amount. I must say, I'm not sure if I fully understand this question, but I will try to address it, 2 ways. The Social Security benefits are taxable up to 85%, depending on your other income. So there's that adjustment. As Judy mentioned earlier, there's Medicare premiums, Part B to be specific, or perhaps Part D, that would be deducted from that amount. If you begin collecting your benefits prior to your age 67, so let's make it 64 as an example, well, in that case, your benefits would be reduced based on your income above the thresholds we mentioned earlier. Essentially, $20,000 is the threshold. So I hope that answers your question. I try to answer it two different ways. I don't know, Judy,
And
if you have anything to add.
Well, just to add that the amount of premiums that you're going to be paying for Medicare are also dependent on what your taxable income is. And it's 2 years, it runs generally 2 years behind. So again, it goes back to managing what your actual total income is and then your taxable income. This all impacts what your actual net Social Security check will be. And then of course, how much of that will be taxed.
That's right.
There's a question, what are the experts saying about the future of Dixieland security? Unfortunately, maybe it's released, but I didn't find it on my search of the web. That the last report that's available is from April 2020, and it's essentially reporting as of the end of 2019. I suspect that it is the economists, boy, their brains are churning to try to figure out the impact of the pandemic on the Social Security Trust Fund as of the end of 2020. But that'll be very interesting when that does get released.
That's right. So I already answered this question. If you plan to work until age 70, is that the point where you must take Social Security? Again, yes. Now, one of the questions I just want to acknowledge that we received, that it's a great question here. It's a longer question that includes multiple figures, multiple ages. So to the person who asked this question, please reach out to Judy or myself directly by email, and we'll be happy to address it for you. The reason we're not addressing it now is because it's very specific. It would require a longer answer, and chances are would need to ask you more questions about your question. So again, you know who you are, please reach out to us. Judy?
Okay. When should I plan for taxes on Social Security benefits and or retirement funds, now or later? Given taxes may change over time, how do I plan for paying taxes on these funds? So the Tax Cut and Jobs Act of 2017 actually will sunset in 2025. It was basically the way when Congress passed it. They had to come up with how are they going to pay for it, and it sunsets, meaning it stops at the end of 2025. So we will revert back in 2026 to the tax rate structure for pre-Tax Cut and Jobs Act 2017, unless, of course, Congress changes that between now and then. There are currently, under the Biden administration, certainly proposals to increase the tax rates prior to 2026. They're kind of burner at the moment because they've got other programs that they want to get launched, including the Infrastructure Act, and also another bill basically to help shore up health insurance and benefits for low-income individuals. So we're not expecting a increase in the tax structure for 2021, but certainly we'll see for 2022, which is a mid-election year. So it could be that it's not going to be until 2026. And again, tax planning, tax efficient investing, use of the qualified charitable distributions, to plan on how much of your Social Security will actually be taxed.
All right, and here's, I guess this would be the final one for me. What is the best strategy to maximize Social Security benefits for a couple of the same age with one spouse accounting for 60% of household income? So when I was looking at this question, it's a great question. One thing I'll say right away, the fact that one spouse accounts for 60% of household income will likely have essentially no impact on this decision. What we would want to know is essentially three things. we would want to know how much each of the spouses would receive at those threshold ages that we discussed, again, 62, 67, and 70. We would want to know their life expectancy. Understanding, of course, it would have to be estimated, but is there a difference in their life expectancy, understanding that they're of the same age? And of course, we need to understand their tax situation. So once we have good understanding of these three variables, we would come up with, again, the most optimal claiming strategy for this couple. But the fact that one earns more money, let's say today, will likely have, again, relatively limited impact on the analysis. Judy, would you
there's
like
one more question about if I put off collecting benefits until a later age and I die before collecting or while collecting, is my special needs daughter entitled to many of my benefits? She currently receives some Social Security benefits. So this is something I mentioned earlier. You on the Social Security website, there's a lot of information, and I would recommend that you go and take a look at the information there and see what you're actually eligible for. But also keep in mind, when you see special needs, consider a estate plan to set up a special needs trust, so that your daughter is appropriately taken care of in the event that you do die, not just from Social Security benefits, but in general, that there's provisions set aside for her needs during her lifetime. So it's kind of a more complex picture that we'd be happy to help answer for you. We would need more information about your total resources and situation.
All right, so unless there are any other questions, and of course, if you don't feel like asking your question now, feel free to reach out to us anytime. As Judy mentioned earlier, we have many webinars coming up. The next one is actually next Tuesday on July 27th at 12 o'clock. We'll be updating everyone on the markets, on the stock market essentially, and sharing some of our best ideas. On August 10th, we'll have a webinar dedicated to younger professionals. We'll be sharing some of the top ideas for those in that age group. Judy and I will be talking about the Son of Secure legislation and how it could potentially impact, actually, not just retirees. It has a lot of impact on many other age groups, let's put it that way. And then on September 16th, Jordan Eggert and I will be talking about some of the top investment and financial planning strategies for mid-career professionals. So we have a lot going on. And I mentioned earlier, just so you know, we'll also have a webinar dedicated to long-term care insurance. We will have a guest speaker who's exceptional when it comes to the subject, but it's in October. That's why you do not see it on this list.
Hey, Alex, can I make one last comment before we close up?
Absolutely.
So I noticed that there are a number of folks in the room who are using their phone numbers to participate. And just in the event that one or more of you may not have been around for the introductory comments, this is Joe Kovacs, by the way. Please do email either myself or Marissa Meisner, who would have sent you the link to this meeting, just so we know who you are and we can send you a copy of the presentation slides. Thank you.
Thank you, Joe.
And then lastly, I think go back one,
sorry.
Alex.
Yep.
Yeah, we do have a special coronavirus resource center on the cbmcpa.com website. For those of you who have any interest in the PPP loan forgiveness. So there is information dedicated specifically to there. And I think that's it. Is that right, Alex?
That's it. So
Okay.
again, thank you everyone for joining us. And if you have any questions, feel free to reach out anytime.
Right. Thank you.
Thank
Take care.
you.
Enjoy your summer. Okay. Bye-bye.
Bye-bye.